Good morning and welcome to the Energy Perspectives Group webinar hosted by Hemisphere Energy. This event will be recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Hi, everybody. Welcome. And again, a reminder, if you have questions during the presentation, just type them into the chat room. I've got 7 here that were emailed to me that I'll kick off with. But anyway, I'm really pleased to have Don Simmons back, the president and CEO of Hemisphere Energy, to update us on their profitable year in 2020 and their plans for strong production growth in 2021 and 2022. Hemisphere is one of my top picks in our small cap growth portfolio. I've been following the company for about 5 years. They increased production 49.7% in 2019. Then, like everybody else, they hunkered down in 2020 and didn't really drill any new wells. But still, their production increased 2.4% just because it was, went from a higher production rate at the beginning of the year. They generated over $8 million of free cash flow in 2020, which will be enough to fund their 2021 capital program, actually, but it was used to pay off debt. The share price has more than doubled over the last 3 months, and my valuation is that it will more than triple again from where it is trading today, assuming that we maintain oil prices in the plus $50 range. But Don Simmons is a geologist by education and trade. He spent the first 5 years of his career working for Encana, which is now changed its name to Ovintiv, which is in our Sweet 16 growth portfolio. Before he moved on to Sebring Energy, a private company that was sold in 2007. That's when he joined Hemisphere Energy as the company's VP of exploration. He became president and CEO in February of 2008. He's done a great job building the team at Hemisphere, guiding the company through a very challenging year in 2020. And Hemisphere is now generating strong cash flow from operation and is well positioned for significant production improvement reserve growth in 2021. So at this point, I'll just turn it over to you, Don.
All right. Well, thanks a lot, Dan, for the introduction and the opportunity to come back and give everybody an update. I was looking back when I last updated the group, and I think it was last August. So quite a different world today from last August. I think we were sitting around $40 a barrel. WTI back then, we're hovering around $60 here today, and certainly a much different outlook on the oil market today than at that point in time. So I really excited with this opportunity. We just put out some news this morning that I can now talk to in this new presentation about where we're headed. A few weeks ago, we put out our reserve report as well, which I'll talk to quite a bit in this presentation. I'm not going to dwell much on looking back. I'm really going to focus on looking ahead in this presentation. We all know that 2020 was overall a challenging year for the oil and gas sector. But for Hemisphere, we fared quite well. We hunkered down early, we cut our CapEx, we reduced costs where we could, and we really focused on 2 things. One, maintaining our production kind of flat year over year, which we did, and the second was to pay down as much debt as we could through the year, and we managed to pay down almost 25% of our debt by the end of the year. So that's really set us up for 2021 and 2022, and we're really excited about the projects that we're kicking off here soon, and look forward to questions at the end of the presentation. Let's get right into it. So Hemisphere, we are a growing energy company. We're growing production, we're growing reserves, and most importantly, we're growing cash flow. Now, a lot of times people ask me all the time, like, how do you sum up Hemisphere, or how do you, what can you tell me in a quick statement about the company? So this is my best attempt at that. I look at it, we reimagine technical solutions to repurpose assets in the energy industry, building value and wealth from our resources. Now, our strategy over the years, we've kept it really based on 4 main principles, and that's being simple, being clean, being profitable, and being unique. And when I mean simple, we have 1 core area and 2 oil pools. These pools are large oil in place and low recovery factors at this point in time. When I talk about clean, and we've always run the company with minimal decommissioning liabilities, and we have a very low environmental footprint. Profitable. We have low cost operations, high free funds flow yields, and we have the top tier reserve values on a BOE basis. And when I talk about unique, you know, we might be a small company, but we've had an active share buyback program the last few years. We're approaching a low debt operation and even towards potentially a debt-free operation. So let's look at our profile. The company trades on the TSX Venture listing in Canada under the symbol HME. And in the US, we trade currently at the OTCQB listing under the symbol HMENF. Our share price the other day was 45 cents a share. When you look at our insider ownership with a board and directors, 13% on a basic, and fully diluted were 28%. Basic shares outstanding just over 88 million, and fully diluted just under 109 million shares. So that gives us a market cap of 40 million and an enterprise value of 64 million. And I ask you to, you know, remember that number, 64 million, because we're going to be relaying that and comparing that to a number of other value markers for the company through the presentation. So let's look at where we're located and some of the key numbers of Hemisphere. So if you look at the map, the Atlee Buffalo is our core asset, our main asset down in southeast Alberta. We're about 3 hours east of Calgary, and about an hour north of the closest city is the city of Medicine Hat. So I mentioned before, we put out our reserve numbers a few weeks ago. So to recap the highlight there, our proved plus probable net present value discounted at 10% of those reserves, $211 million and just under 15 million barrels. On a proved basis, net present value discounted 10%, 170 million and 11.7 million barrels. And on the blowdown case, or the proved developed producing case, discounted 10%, 81 million and 4.2 million barrels. Our current corporate production through most of the month of March, up until a couple days ago, 1,850 BOEs a day, and we're 99% heavy oil. The end of the year, our estimated net debt was $24.5 million. And something that we're very proud of, we've been cognizant of through our entire corporate history, is making sure that our abandonment and our decommissioning and our reclamation obligations are low. We haven't bought assets with a massive amount of liabilities. We've done that on purpose. So we're very happy that we look at these things as another form of debt in some ways, and we've been able to keep our liabilities down to $8 million on an undiscounted basis. If you discount that at 10%, it's less than $2 million. In Alberta, they have a system where they grade these, or they have a ratio to compare companies. We're in the top 7% of Alberta companies, and what it's showing is that we're basically at 10 times of our deemed assets or our producing assets to our deemed liabilities, the abandonments and reclamation. So puts us in a great position compared to a lot of our peers. So where are we headed? So our news out today, we talked about a guidance and a budget in a $60 WTI oil environment, and it's focused on growth and debt repayment. So if we look at 2021, our average annual production of 1,900 barrels a day, we're exiting or looking to exit at 2,200 barrels a day. Our funds flow from operations for the year, 19 million. On a per share basis, that's 22 cents a share. Capital expenditures planned this year, $6 million. This leaves us free funds flow of 13 million, which in our case this year, we plan to again apply that to our debt position. So we're looking to exit the year at about $13 million debt gives us a debt to funds flow ratio at the end of the year less than 1 times, 0.7 times. So again, compared to our peers, in a great position there. As we look ahead to 2022, we're looking to increase our average production to 2,550 and our exit production to 3,000 barrels a day. Funds flow up to $30 million on a per share basis. That's 34 cents a share. CapEx expenditures planned right now is $7 million. It gives us free funds flow of $23 million. Unless we, apply that to a project or an acquisition, we'd be sitting with $9 million in cash at the end of 2022. Let's look a little bit closer at the revenue breakdown for Hemisphere in a $60 WTI world. So looking at 2021, if we look at the chart, we go clockwise around the chart, about 17% would go to royalties, about 19% to OPEX, about 13% to our hedging and G&A and interest, 16% to CapEx, and that leaves 35% of our revenue that's free funds flow. So a great high yield free funds flow. As we move to 2022, that free funds flow increases even more, up to 45%. So this is key to being able to have financial flexibility as we move forward with Hemisphere and all the different options that we have. When we look at these high free funds flow and we look at some different pricing sensitivities here, if the oil price drops $50 down to 50, drops $10, I'm not going to go through all the numbers, but let's have a look at some of the key ones. If you look in 2029, we'd still have 17 million of cash flow for the year. We'd be exiting the year about 15 million and still under 1 times debt to cash flow or debt to funds flow. If you have the more bullish view on the world, you look out to 2022 in a $70 price environment, we're up to 36 million of cash flow from operations. That's 40 cents a share. We're trading at, I think, 43 cents this morning. $29 million of free funds flow, and we'd be looking at in a cash position if we didn't allocate that capital somewhere else to $15 million. So what do these high free funds flow yields mean? They mean a strong balance sheet, and they mean financial flexibility. It allows us to pay down our debt, allows us to accelerate our internal projects that we have, make other strategic acquisitions, and return capital to shareholders, either through continuing to be aggressive and buy back shares in the market, and or potentially even dividends in the future. So let's talk about our reserves in a little bit more detail. We put this news release out a few weeks ago that highlight all the different reserves. I'm going to hit some of the high notes. But really, the reserves of an oil company, it is the foundation of our company. It is a picture of where we see the company going and potentially the kind of cash flows we're looking at over the next number of years. So our reserves at Hemisphere, we have long life reserves, high quality reserves, they're low decline. And a lot of that is a function of the fact that we have enhanced oil recovery or EOR projects that we work on. When we recap those numbers from the reserve report again, on a 2P basis, the proved plus probable, $211 million discounted at 10%. The proven, $170 million discounted at 10%. And the PDP or the blowdown case, $81 million discounted at 10%. There's 2 points I want to add to that. All of our decommissioning liabilities are accounted for in those valuations. And number 2, these valuations are made on a price deck from our reserve auditors that have a $47 WTI price for 2020, and it escalates up to $56 for 2025. So again, compared to where the oil market is today at $60, reasonably conservative numbers. So we look at our projects, we look at our wells, we look at the different things we're doing, high netbacks, quick payouts, and exceptional rates of return. When we look at some of these key reserve metrics, 2-year average proved F&D costs, find and development costs of $2.32 a barrel. 2-year average proved recycle ratio, 11.6 times. Proved reserve life index of 18.8 years shows we've got room to run for years ahead of us. On a per BOE basis, the value of our reserves in all the categories, higher than our peers, 19 different peers that we've compared ourselves to that are conventional, oil-weighted, publicly traded companies. Let's have a look at that in the next slide. So here again, on the y-axis, we have the value per barrel of our reserves. And on the x-axis, we have all the different companies. So it's 20 different companies, including ours. You can see from all these different companies, in all three categories, the value of our barrels on a per barrel basis of reserves are higher than all of our peers. And this speaks to the type of reservoir, the type of asset that we have at Hemisphere. Now, that being said, let's compare that to our enterprise value, the value of those reserves compared to the enterprise value of our company. And we trade at the opposite end. We're actually trading the lowest compared to our peers. So this creates a huge value or exceptional opportunity of Hemisphere in the market today. And part of that reason, I mean, yes, we are the smallest company here, but one, this is just, a lot of this news and the idea of where we're going, it's just coming out to the market, in some cases just this morning. So, I think it's part of our issue is getting our more eyes and more people knowing the Hemisphere story. But you can see here, we've highlighted in the dark bar is the PDP value to your enterprise value. And you can see most companies trade at least above their PDP value. And many of these companies trade at their proven value. And trading at your proven value in today's market seems very reasonable to me, in a $60 price environment. If we dig into this a little bit deeper and look a little bit more specifically at the values and the share prices associated with it, on the y-axis we've got the dollars per share. On the x-axis we've got the different types of our reserve classifications. So you've got your proved, developed, producing reserves. You've got your total proved, and then you've got your proved probable. And then we're looking at three sensitivities. We're looking at in the blue, the reserve auditor's price forecast, which I mentioned before, $47 for 2021, escalating up to about $56 for 2025. The green is a case with the same reserves run at a $60 price, and then the black at a $70 price. And you can see the yellow dashed line. That is where Hemisphere was trading the other day at 45 cents. So you can see if we look at the consultant price forecast on a proved, developed, producing basis, our debt adjusted share price would be 63 cents. If we look at the proved in the blue, $1.64. And if we looked at that same price forecast in the 2P or the proved plus probable, $2.12. If we look at it on the $60 sensitivity, 83 cents a share on the PDP case, up to $2.05 on the proved, and $2.56 on the proved plus probable. And obviously the $70 case in the black, even higher. So again, really just highlighting the opportunity and the upside potential for Hemisphere here. Let's talk a bit more about our resource and the pools that we have. So Atlee Buffalo is our core area, as I mentioned earlier, down in Southeast Alberta. We have two oil pools. They equal 84 million barrels of total oil in place, and current recovery is about 5% of that oil. So this is key to understand. As an oil company, our job every day is we look for ways, as I mentioned, we look for solutions to increase that recovery factor on an economic basis. So finding better ways to get more of that 84 million barrels out of the ground economically. We're not a mining operation. We will never get to 100% recovery. That is not what happens in oil. When you look at primary recovery, you usually get anywhere from maybe 3 to 7%. You go in, you do secondary. In our case, we drilled horizontal wells, then we did a water flood. So you continue to increase that recovery factor. And now we're starting to talk about this. The next step of some of these projects is going to a polymer flood. And the idea behind this is just to get a higher recovery factor of that oil out of those reservoirs. So when we look at these projects, they're low risk, they're highly lucrative, enhanced oil recovery projects. Why are they? We have excellent quality reservoirs. These reservoirs are delineated by both vertical wells, and we have 3D seismic over them. When we look at some of the costs associated when we drill our wells, they're only $800,000 all in. Why are they so cheap? Because they don't require fracs, and that's due to the high permeability and productivity of the reservoirs we have. Another key part on why our economics can be so good is that we already have existing facilities in both of our pools, which are easily expanded as we continue to grow our production. One more point to make is that our most recent reserve report that we put out, it currently recognizes polymer flood for just one of our two pools. So the most recent booking does reflect the impact of polymer flood for the G pool. And that's due to the fact that we're starting up this polymer flood here in the next quarter. Now, that being said, we also believe that there is substantial unrecognized reserves remaining, and that's why we'll continue to evaluate and look at moving forward the polymer development for our F pool. So let's look at the development plans for 2021. Our plans are to convert our G pool water flood to the polymer flood. As I mentioned, we're going to drill 3 wells in the G pool, and we're also going to expand our G pool facilities to handle the expected increase in oil production. At the same time, we continue to do our evaluation of the F pool conversion, make sure it's economic. And with that, then we would submit our applications to the regulatory body at some point during 2021 if it is economic. When we look at plans ahead for 2022, right now we've got plans to drill 3 more wells in the G pool, continue to optimize that new polymer flood, and start then development again back in the F pool. 4 wells planned there. And again, assuming things are economic, move towards implementation of the polymer flood in the F pool. So why polymer? For one, it is a tried and true method and proven method of enhanced oil recovery. A polymer, in our case, we add it to our injection water with the idea that we're just going to increase the viscosity of our water. And what we aim to get is a viscosity, something similar to an olive oil. Now, this results in a wall that's built up between the water and the oil, and this pushes more of that oil to our producing wells. And the idea is we sort of stop the water from streaking through the reservoir. So if you look at the diagram, you can see our 3 horizontal wells drilled through the reservoir, the injection well in the middle. In the yellow, that's our polymer wall, and it's pushing that oil wall to each of our producers on either side. So what this typically ends up in is we get an increase in our oil production, we get a decrease in our water production, and overall, we get an increase in our oil recovery of the reservoir with a more efficient sweep. So this is a big change, an exciting change for Hemisphere. However, it is a very calculated risk. This isn't something crazy new. Polymer flooding is successfully used in many, many parts of the world, in hundreds of pools, and by many companies around the world as well. Many of the companies that I've mentioned here are Canadian companies, but that we're familiar with. But even down the U.S., you'd recognize the BPs, the Chevrons. Hilcorp is a U.S. company. So again, these are techniques that have been used for decades, and really just, I think, if anything, the scale and the costs have come down, so it's easier to do in a price environment like $50-$60. The Atlee G Pool project, it is ready to go. Construction starts here in the next few weeks, and our first injection of polymer is planned for late in Q2 2021. So let's look at our ESG. Again, these are just values that we've built our company on, and we're at the point now where you realize not everybody even knows what we do. Some of these things, they just come naturally. They're part of growing a company and building a company, but we'd like to talk a bit more about it. From an environmental standpoint, we've always run the company with a view of keeping a low decommissioning liabilities. We do not use surface or fresh water in our EOR operations. We use natural gas for our power generation. We do pad drilling to reduce our environmental footprint, and we pipeline connect our fields in order to reduce trucking. From the social side, we certainly like to be completely aligned with our communities. We hire local companies and local people, and we support the businesses in and around the communities we're active in. And obviously, we always want to have and continue to build positive relationships with all of our stakeholders. From a governance standpoint, number one, safety is extremely vital to all of our employees and our stakeholders. And we have, as a management team and a board, always continued or have built and will continue to build a culture of honesty, integrity, and accountability. Here is your leadership team. We're a management team that's worked for many years together now, and we're supported by a great board. And I will say, speaking on behalf of the management team, we are extremely excited about 2021 and the projects we have coming up. We've been working very hard, and I'm excited to be able to come back to you through the year, hopefully at least one more time, if not more, and give an update on how this project is moving forward through 21 and into 2022. So I'll leave you with that. That is the Hemisphere story. Again, I'd like you to think and reimagine developing a simple, clean asset of exceptional profitability. I'd like you to think about us repurposing, breathing new life into our used equipment and our old conventional oil pools. And the number one thing to take away is the value of our resource and the importance of it to Hemisphere. And a team, we're maximizing that recovery of our top quality oil pools using proven technologies. Before I hand it back to Dan, I will mention that this presentation is on our website. So you can go and view it there. There are some forward-looking statements that you can flip through and look through. There's also some other slides in the appendix you may find helpful for some of the additional details. And with that being said, I will hand the keys back to Dan, as I'm sure you've got lots of hard questions for me to answer.
Hey, thanks, Don. Before I ask questions, I want to tell everybody, I wish that all the upstream companies I looked at were as simple and easy to forecast as Hemisphere. Would make my job a lot easier. And frankly, I want to say this is why you guys pay me the big bucks for your EPG memberships, to find undervalued, simple growth stories like this. Eventually, they do figure it out in the Wall Street gang. But I'm going to start with, I got 6 or 7 questions here via email, and then we've already got 3 entered through the chat room. Chat box. So if you have a question, just type it into the chat box, but we'll spend as much time as it takes here. But so here's what the first question is: what are the economic differences between your Jenner area and Alti Buffalo, and what makes Buffalo Alti more attractive and better suited for the polymer flood?
Sure. Yeah, just as you'll notice in this presentation, I don't think I even mentioned Jenner. Jenner is, it's a different play type. It's oil over water. So, really what happens is it becomes a stripping operation. So your well might start at 150 barrels a day, but 2 years out, you're very high water cuts, 97, 99% water cuts. So with that case, it has much higher op costs associated with it. So that hurts the economics in compared to Atlee. And the second part is, because of the oil over water situation, it's not a candidate for polymer flood. The polymer would just get lost in the aquifer, and therefore that's what makes Atlee and the 2 pools there so unique, is that they're just oil. We introduced with our water flood the first water into the system. Now, so that's why those make such great pools for water flooding and then polymer flooding.
Okay, the second question, and it kind of refers to in Canada, you use the term netbacks. which isn't really used in the US very much. But how do operating costs move within the operating netback calculation? Which costs are fixed, variables, and how do they relate? Do they go up and down with production or what?
Right. Okay. I actually didn't know that netback wasn't a common term down there. So really, what we talk about is a field netback. So your wellhead price per barrel minus your royalties that we pay to the government, minus your operating and transportation costs. So that's what we talk about as our field netback. So on an operating cost side, I think, on average, we're probably about 25% of our OpEx is fixed. So yes, with scale, with production increases, we do get some economies of scale on the operating costs. And we would expect some of that as we go forward. However, for a heavy oil company, our operating costs are phenomenal. I mean, down in a $10 a barrel range for last year is really a very good operating cost, and have to give a hats off to the operations guys and the operators in the field.
Okay, this question from Scott, and I think you kind of addressed it in the press release today, but he says, this is back from his notes of the September 18th podcast, is the last time you presented to us. You talked about 2019 being a transition year from growth based on borrowings to ramp up your production. And then you additionally spoke about 2020 being a pivotal year, where in response to the pandemic, you then had to retrench and focus on efficiency, laying the groundwork for 2020, paying down debt with the free cash flow. If 2021 turns out to the way you plan, the polymer flood production increases and cash flow increase allows you to pay down a much larger portion of your $20 million cash flow toward debt. How does that set up 2022? And I think you pretty much covered it, as you're just going to, expand the polymer flood. So I don't know if you want to add anything there.
Yeah, I guess, I mean, just to talk a little bit about that history, I don't remember exactly what I said before, but when you do look back, when we, as we've built Hemisphere, and when we first started talking, Dan, we were and we still are, but a very reserve rich, cash flow poor company at the time, and needed access to capital in order to build the facilities and drill the wells to get the cash to build the cash flow. So when we look back at 2018, we borrowed money in order to build those facilities and drill the wells to build that cash flow. We borrowed more money than we made. In 2019 was an interesting year, or a big switch in that year, where we didn't borrow any money, but we didn't pay anything back. We had $13 or $14 million of cash flow, and our CapEx program was $13 or $14 million. You look at 2020, and it wasn't planned to be that way, but in the end, with the way the volatility and COVID, it was interesting that, yes, we only spent, it was like between $1 and $2 million in CapEx last year, but we were able to keep our production flat year over year and have excess cash or free cash flow to apply to our debt. Now we're a company in 2021 where we're doing both. We're going to pay down debt, and we're going to continue to grow the company through our existing assets.
Yeah, I think you're in great shape now. You're where all small caps need to get eventually, is where you continue to grow, but you're not having to borrow money year after year after year. So.
Well, yeah, it's a great comment. I mean, that's really, we look at it is for small caps, it's a totally different game.
It's a struggle to get over the hump. Yeah,
you have to be over the hump. You have to have a good balance sheet. You cannot expect that you can just go to the market and raise capital even if you did have a great idea or a great project. And two, you can't expect to just be able to have a credit facility that you can use as part of your balance sheet anymore. It's just not the way the business is going to run in the future, or we don't believe so. So that's why you're seeing us make the moves and set up the company the way we have.
Yeah, and you're unique in the fact that you have low decline rate fields. I mean, the problem with the shale wells for the small caps are when they have a pullback in price, man, they just can't hardly stop drilling because their production will fall off so quickly. Because these shale, well, they come on strong. I mean, when you got $60, $70 oil price, the economics on these shale wells is outstanding because you get it all back. You know, they pay out in 1 year, but boy, when the price crashes, you got a lot of exposure. So that's why they got to have a great hedging program. Okay, his next question was on the September podcast. You mentioned that Alti Buffalo is your primary focus, and the property was a diamond in the rough, and now a cash cow. So you might add how you found Alti Buffalo to begin with. But then given that 2022 has a potential to be a harvest year, and given that tax rates seem to be going up everywhere, and in particular, they're talking about raising the capital gains tax, under what condition would you declare a dividend, and when might this occur? And if everything goes as planned, what percentage of free cash flow could you use to pay dividends plus substantially keep the growth of the company going?
Okay, there's lots in there.
Lots of questions here.
Just to quickly address Alti Buffalo, you'd asked sort of how we came about it. It is an asset that I first mapped as a geologist, 20 years ago. It did take a long time to get it into one umbrella, under the Hemisphere umbrella. But they were buried assets in larger companies. We didn't discover these assets. They were discovered in the 70s and early 80s by Dome Petroleum, and there was a U.S. company that had found them as well, and we just basically took them as these old pools that no one was putting any money into. They were neglected. We managed to buy them off the operators and consolidate the assets with the vision that what we needed to do was come in, drill horizontal wells where they only drilled verticals, and start a water flood to get pressure maintenance and move that oil around. So that's a very high level, quick background of that. I think the next question is really referring back to our high free funds flow yield. What do we do with that? And I think I did talk about that in the presentation. That number one, I think debt repayment and continuing to move these projects forward are our top priorities. As we move to a low debt environment and the polymer projects are up and going, if in the new model of small companies, we are not going to trade where we feel we should be trading, then we have to find other ways to return capital to shareholders. Mm-hmm. One way of doing that, and we've already been active about it, is share buybacks. And I like share buybacks if the price is so low. I mean, compare buying our stock today at 45 cents and ripping up those shares compared to drilling a well. I mean, the rate of return, they're 100+% rates of return in both cases. So, we certainly will continue to look at that. And we now, for the first time, we've thrown out the idea of dividends. If we get to these points where we have these high free funds flow, if we're not seeing projects that we feel can add significant value to the company, then yes, we are saying that is something in the future that we will possibly look at, is dividending out to shareholders. It's not because, I haven't really thought through the tax implications or if they're going to increase capital gains. You guys probably have in the US now a lot of the same concerns around that we do in Canada. I think, shareholders buy companies, especially companies like Hemisphere, and I'm a shareholder, we all want a return on our investment.
Right. Let me go to the questions here that were emailed in. Okay, how does the cancellation of the Keystone XL pipeline, how does that impact your company?
Okay, you know what? I'm going to flip down. I added a slide in the appendix just in case a pipeline company or question came up. Can you guys still see that?
Yeah.
Okay. So Keystone directly doesn't affect Hemisphere. It's more, and Dan, I think you and I have talked about this a few times. We need more egress out of Canada. So Keystone was one of the solutions that would have helped with that, or Keystone XL. The other ones are Line 3 replacement, which is unless there's something comes out of left field on the court side or a protest side, it should be online by the end of this year, adding almost 400,000 barrels of egress out of Canada for heavy oil. And the next one is our government-owned Trans Mountain pipeline, which goes from Edmonton out to Vancouver, out to our west coast. And that is being built, and that is scheduled to be online late 2022. So there is light at the end of the tunnel, or at the end of the pipeline for Canadian producers so that we will have egress to get our oil to market. And line 3 is a market out to the east, and the Trans Mountain line is a line out to the west for us. Keystone would have helped. As far as my view on it, I'm more shocked that the US would not want this pipeline. This is a national, strategic, important pipeline locking in a massive resource and their neighbor in energy security for decades to come. Whether you even want to use it or not, at least having the pipeline and having that capacity there to get more barrels down to the refiners that can really use it on the Gulf Coast, it makes sense to me from a U.S. point of view. But that being said, it wasn't approved. It wasn't a huge surprise to most of us up here. I mean, the president did mention that, in his campaign, that it was something that he would do, would cancel that. So, not terribly surprised at that outcome. But, why do pipelines and egress, why is it so important? It affects the differential, the discount that we have on our oil when we transport it or ship it to the U.S. And so, the differential has been very good, very strong the last little while. And I think it should remain strong with line 3 coming and with the Trans Mountain pipeline coming.
Well, if we made a list of all the illogical things that come out of Washington, D.C., my friend, it's a long list. So just leave it at that.
No different in Ottawa.
I know. I got an idea. Why don't we just put Ottawa in with about 6 or 7 states up there to the Northeast, and we'll make the new country illogical land or something anyway. Also, with such great positive numbers that you have on your pure your per share net asset value is double or triple, I think, what the current share price is. Why is the share price lagging, and how do we get that fixed? Whoever's selling your shares, tell them to quit selling them, right?
This is why I'm here today. I mean,
right.
So, I think it really is getting the story out. Like the world has changed in so many other ways for small cap companies in the oil and gas space. So is true from the marketing standpoint. I mean, with COVID, I haven't even been able to get on an airplane and go see anybody. So everything's been through Zoom or other webinar ways of doing things. But the other big difference over the last number of years here is we just don't have the funds that buy, small cap junior oil companies the same way. So it's a different approach, which is, again, I'm expanding the way that we're going to, get our story out to retail investors. So doing more of these presentations, we've got some online marketing we're looking at. You've seen here today, this is the first presentation I've used our new corporate presentation. So, hopefully it looks attractive to all of you guys. We've got a new website coming. I mean, these are the ways that we can continue to attract new investors. But so the big part is, I think, just continuing for me to pound the table on how great of a buy it is. And eventually we will get recognized in the market. I also think as we sit right at this point in time, there is some hesitation on oil and oil price right now. I think there's been a great run up on it over the last number of months, as we all know. And I think now people are just now wanting to see that summer driving season truly kick in. We need to see some continued draws on the inventories, and that'll give people some confidence to step back in and start buying oil stocks again.
Yeah. Well, one thing I might add here, and I'm going to talk about it in my own webinar on Friday, the weather in February, late February, that knocked out the power in Texas had a significant impact on the refinery on the Gulf Coast. Dozens of them were forced to shut down on short notice. Whenever they shut down on short notice, and they cannot do it in the proper stages of shutdown, then they're required to do a significant amount of pressure testing, vessel testing before they can come back on. And they're just now getting most of the refineries back online. And so what that happened was, even though some of our production went down, the refineries went from 83% operating capacity down to like below 60% operating capacity. We lost like a quarter of our refining capacity within a few days. And, you know, refiners are the people that are the consumers of crude oil. And then what happened was crude oil inventories built up. And, you know, because the Wall Street gang focuses so much on how high the inventories are, that's caused some traders to back off on the oil price. But I think we're back up again. I think we're going to see a steady decline in U.S. crude oil inventories going forward, as they absolutely have to ramp up production of gasoline. Gasoline's below the 5-year average, and we're weeks away from the peak in demand for gasoline in the driving season. So, you know, I don't see oil going much level. I personally think under $50 is totally unsustainable. So, yeah, that's got to get back. But anyway, back to the questions here. What is the status of Alberta royalty holiday application time frame? Yeah, how does that affect the royalties you have to pay?
The royalties, well, yeah. So there hasn't been any major royalty changes. What the government does do is they do give out incentives. When you drill wells, you get a 5% royalty holiday for certain wells, and in some cases for the polymer projects, they will look at some royalty holidays. Now, you know, I also do know that the Alberta government is the budgets are in not great shape. And so giving up any royalties for very economic projects would be very difficult for them to do. So, you know, I think if we get any form of holiday for the risk that we're taking, I think that would be great. But at this point, it's not in any of our numbers go forward. I think, you know, we should expect just to have the normal royalty system that we're under. It's very different than the U.S. system. We do slide. It's more of a sliding scale based on price. So when the price goes down, like we've seen over the last few years, our royalty goes down significantly. However, then when the price does scale up, it does scale up to a higher limit. But you know, that is one. It's almost a natural hedge that is put into the royalty system in Alberta.
Yeah, yeah, and it's one thing that, you know, down here in the U.S., I mean, typically we're paying a 25% royalty to the mineral owners, and you don't have that on these crown lands. So you just have, you know, the 5-10% Alberta royalty, which is, you know, better netbacks for you guys. Okay, next question is, any plans for an acquisition?
Well, I mean, we're always looking. Let's put it that way. I mean, you know, we're always looking at opportunities and then comparing them to the internal projects that we still have, particularly in our Atlee Buffalo area. So, you know, we're geologists and geophysicists and reservoir engineers. It's our job to continue to look for value adding opportunities, and we will always look for those, continually look for those opportunities.
Are you seeing any of the deals? I'm seeing where companies with money are coming in and saying, look, we're not going to pay for any leasehold costs, but we'll drill to earn. We'll pay for 100% of drilling and completion costs for, you know, maybe a 90% revenue interest until payout, and then a payout it flips. It flips back. Maybe you get 75 or 80% after a certain payout. Are you seeing deals like that up there?
No, not really. I mean, the deals that we are seeing seem to be like takeovers, right? So
yeah,
typically still some, not all, but somewhat distressed companies that have good assets, but, you know, just they don't have the cash flow or the ability, or they have some debt restraints in order to move the company forward. So therefore, a bigger, healthier company or another company is coming in and making an offer to be able to find a solution to move those assets forward under a new company.
Mm-hmm.
We are also, what I would say, seeing even two good companies combining together. They see that together they're stronger, they're bigger. They, if it gets them maybe to 100,000 barrels a day or more, you're getting to the level where the funds may actually then invest in you. So that, we're seeing a bit of that in Canada as well. But overall, yeah, I mean, there certainly is a theme of consolidation. And I think, there's probably going to be a few more deals as we see through 2021 and 2022. As if we do continue to see a strong price like this, I think you'll see more and more deals.
Yeah, I tell you, we've got a lot of these SPACs that are being people raising a lot of money that don't even have anything, and then go out. If I was advising some of these guys, I'd say, man, look for 3 or 4 of these small cap upstream companies that, when you combine their assets, it's a win-win for everybody. You can, reduce overhead and really put something together. And you guys would be a perfect fit because you're a cash flow positive company there. So anyway, do you have any near-term goals to sell Hemisphere within a few years?
I love that question.
Yeah. Always, if the price is right, everything's for sale, right?
Exactly. I mean, let me put it this way. Hemisphere, when I first started, was a 5-year plan, and I'm 10 years into it. So,
yeah.
It's we've got a great company. We've got a great asset and a huge amount of value there. Everything's for sale for the right price, but we will not be giving Hemisphere away. So that's that's about as best I can answer. But we're everything has a price.
Yeah, that always is. Hey, let me ask you this. Okay, final question here. If oil goes to $80 this summer, which is Goldman Sachs' current projection, by the way, there's predicting $80 Brent sometime in the next 6 months. So, will you expand this year's drilling program? And my add-on to that question would be, how many more wells do you have to drill at Alti Buffalo? There's more horizontal production wells to be drilled there?
There are. Yeah. I think off the top of my head, I think we've got another, I think between the two pools, maybe 20 more locations, something like that.
Okay, good. Yeah.
So, in an $80 environment, I don't know. I mean, I haven't dreamt of $80 for a long time. Let's put it this way. Look how quickly we moved last year when the price dropped to $20. We have the ability as a small company to be nimble and to move quickly. If we felt that 80 was there and sustainable and the right thing to do was to capture some of that additional cash flow and put it back into the ground, that's certainly an option. But that's the one nice thing about being at a small company is we can react quite quickly to what we see in the market.
And all these forecasts about supply and demand for oil, they seem to focus on demand. Like, when are we going to get back to, pre-pandemic demand levels? But you very seldom see anybody talk about the supply side. U.S. production's down 2 million barrels a day. I would say out of the U.S. and out of OPEC Plus, I think in the rest of the world, that production is down about 2 million barrels a day. So we're looking at supplies declined by 4 million barrels a day from where we are. So, and then I also wonder on the OPEC Plus side, where they keep saying they have the 7 million barrels of additional production they can bring online. That's not going to be as easy as people think. I mean, there's maybe 1 million barrels they could bring online quickly, 2 million barrels maybe, but that other 5 or 6 million barrels a day is going to take some spending and drilling more wells. It's not going to be overnight. So.
Yeah, I agree. We don't, a lot of people are still under the impression that we don't need, oil in the future, that we're going to need less and less of it. That we've peaked in fossil fuel demand. And we're not seeing it. I think we're still seeing numbers that are drastically affected by COVID and jet travel and so it'll be interesting to see how this plays out. you know, I would agree with you on that, there could be a surprise at some point in time to the bullish side, that supply isn't as easy to turn on as people had thought or had hoped.
Yeah. And actually, in the most aggressive Green New Deal plans, you would actually have an increase in the near term over the amount of oil and gas you would need, because of the mining increase, the building of all these, you know, EVs, and build out of a more powerful electric grid would take a lot more oil and gas supplied energy in the short term. So anyway, it's this wild plan that nobody can really understand the scale of it. Anyway, so Don, we'll leave it at that. And I really thank you for the update. I'm very bullish on this company. We will be publishing an updated profile on it sometime in mid-April ourselves. And for those of you on the call, we'll have a webinar on Friday. That's just going to be me, so you can ask me more questions about the regular market. Anyway, okay, thanks a lot, Don.
Well, thank you. I appreciate everybody taking the time to listen, and look forward to giving an update later on in the year.
Okay. All right. Thanks a lot.